So again, happy for people to turn on your mics, ask me questions as I'm going through today's tax topic. So obviously with end of financial year is fast approaching, only 2 weeks away. It's pretty pressing time. Can everyone see my screen? Yep. Thumbs up. Perfect. That's a lot of thumbs. Again, participation is always welcome here. So with tax time fast approaching, it's really what do we need to know? So broken this webinar into a few different areas because I know there'll be people that are, mum, dad, wage earners, business owners, and super investors. So I've kind of got to hit a couple different topics to, suit the wide variety of people that we have here. So please bear with me. We are going to cover off on as many things I think is relevant from an individual tax return perspective, relevant super side of things, and then relevant from a business perspective, and what you should be looking out for in the next couple of weeks and how you should be positioning yourselves for the next 12-month period, depending on what you're doing. So without further ado, we'll jump into my favorite slide. Any of you, I'm sure everyone here has read the financial disclaimer or a disclaimer before. Catch Advisory and its subsidiaries, together with its owners, managers, employees, have endeavoured to ensure all information is accurate. You must undertake your own research, seek advice from your financial advisors, brokers, and accountants who are certain its application to the specific circumstances. We do not take responsibility for any outcome based on this material. Thanks, lawyers, for that. But again, I am a qualified accountant. We did used to own a financial planning business, and we actually owned a mortgage broking business as well. Currently, we just own the accounting firm, and I part own a structural steel business. And I do a lot of investing myself, both in properties and in the share market. So if you've got any questions, tonight, again, please, I'll just quickly stop sharing for a second while I grab my chat box because I lost that. Please type in the chat box any questions that you have, jump them in there, and I will try to go through those questions as soon as I see them, as I think it's relevant to get the questions as quickly as possible. If I don't get to a question, if you do reach out to me at contact@patcher.com.au, then I'm happy to answer any other questions that you may have about any topics, and just try to keep, for your personal perspective here, we'll just try to keep your personal information, secrets on that context here. You don't want you to post up too much personal stuff in there about what your income is, properties, that type of stuff. So from an individual tax return perspective, one thing that we've noticed is that on the rise right now is the ATO audits. So we've had a lot of, obviously, government spending via grants, via different funding mechanisms over the last 2 or 3 years due to the COVID situation. And now it's time for them to claw back the money. So if anyone read the budget, they've put a substantial amount of money into the ATO audit department, and we're seeing that come through even with recruiting. So we are actually seeing, which is crazy, that the ATO are going out there and targeting accountants at accounting firms to pull them into their auditing departments to go after people. Hi, Peter. When I'm looking at an individual tax return, the first thing is that you guys should be aware of is anything that we want to claim in the individual tax return, we have to have a receipt for it if it's work-related expenses, protective clothing, union fees, self-education, and that's trading mastery fees for all those that are part of trading mastery. We have to keep the receipts, and we want to be looking at here is very simply is how much money did you spend during the year on work-related expenses or on your investment expenses. And you look at that and go, well, you might have internet at home, you may be working from home, so you may want to use the working from home claim of 67 cents per hour. And you might say, Gary, I work from home, 1 day a week, so 8 hours a week, times that by 52 weeks, less your holidays, and probably come out around 42 weeks in its entirety. And that's how we come up with that calculation. But my favorite thing to do with individuals is have a spreadsheet when it comes to Investmenting, so investments that you've got, so whether it's an investment property, whether it's a business, or whether it's shares, you want to be tracking all this stuff yourself on a spreadsheet. The big reason for that is that we become more, we make better decisions when we're the ones inputting that information into a spreadsheet, and we become more accountable for those decisions. So when I'm doing an investment property, I've got my, my rental income, my total for the year, my total for my expenses. I've got my different expenses in there, but I can see what the net rent is. And while these rising interest rates are going on, I'm able to, calculate what effect that has on me as an investor by keeping these spreadsheets. And if we want to do anything serious, we should be tracking it with KPIs, just like our share portfolio. I like to do spreadsheets where I've got my purchase price, and I've got my purchase price, and I've got my dividends or reinvestment of those dividends, and I'm running at my market value so I can see it. But I like to manually do that and keep track of that manually over the course of the year, because I think I have more power, more accountability to those decisions when I'm the one physically typing the numbers into the keyboard rather than printing off. I don't have a report in front of me, but rather than printing off a report, looking at a number of reports on them, be like, oh, my Apple stock's are up 28%. But it's more impactful or more accountable when you're running those spreadsheets yourself to be taking, full accountability of those decisions. Someone's reached out to me in the private message bit and asked me a question about the trading mastery. So if you do pay for trading mastery and you are trying to claim that as an expense, you can claim that expense in your tax return under the investment deductions. So again, speak to your accountant and put it under that section. It's called an investment deduction. So you are allowed to claim expenses that relate to your investments, and you claim it under there. Whether you had, $5 worth of dividend income, or you had $100,000 worth of dividend income or no income because you haven't received any dividends yet, you still will be able to claim it under that section of the tax return. Also, you will obviously need to have the receipt. So you'll reach out to TM if you don't have the proper invoice, get them to send you the invoice. If you've lost it or something, they'll be able to send that across to you. Renee, when building an investment property using equity and the build isn't started yet, but have paid a deposit, can you start claiming deductions on them in the interest repayments? So with an investment property, if that property hasn't finished construction, so we're during the construction phase, unfortunately, the way that we calculate that property is it becomes a part of the cost base. So all the interest is part of the cost base, the build, so the builder's expenses, part of the cost base, the architect, the drawings, structural drawings, any other like council rates, water rates, any other type of fees are all part of the cost base. So when you sell it, your purchase cost is a bit higher. So unfortunately, you can't claim those holding costs against your income. It has to be only claimed once it's rented out is the only time you're allowed to claim those expenses. So once you derive income from an investment property is when you're able to start claiming those holding costs, which is the interest, council rates, water rates, that type of thing. James has asked, when an investment property is purchased under a super fund, does the depreciation claim over the years have to be paid back when it's sold after retirement, as this is the case if purchased privately? Okay, interesting question. So I'm going to make a couple assumptions there, James. When you own a property under a self-managed super fund, you hold that into, we're saying you're holding that into retirement. So I'm going to say you're above preservation age, so above 60. Then when you sell that property, it's going to be capital gains free as long as you're not over the $1.8 million balance cap. So again, in that context, I would make the assumption, I could be wrong, that you're under 1.8 million, so you wouldn't have to pay back any tax related to the depreciation or anything like that. But if you send me the exact details, I can give you exact advice on that one. Again, if you with the trading mastery fees, if you haven't started trading, purchasing, investing, doing that yet, then there has to be the nexus between you being an investor and you incurring the expense. So I'm not saying you should go out there and go buy $10,000 worth of Apple stocks today, but you need to have some form of investment to be able to say, this is why I've got my investments, and this is where my fee is going to get allocated to those investments. So you can see that it's the tax year. It's relatively simple to last year, similar to last year. So what if you're claiming things last year, you got investment properties, you got shares. If you're doing it last year, you're probably going to do it very similar to this year, because there's not much difference from a tax law perspective, or no major changes. The big ones here are just setting yourself up correctly for the next 12 months and making sure that you're happy with how everything's working. So from an investment perspective, and for all those investors on this call that are buying shares, buying properties, this part is really for you in this section. So again, whether we have shares or we have investment properties, remembering we're only paying tax when we make a sale. When we're making a sale there and it's realized. So when we physically sold it. So what happens here is, under a property, we've got to look at the contract date of selling a property rather than the settlement date. So we have to be careful there. And the exact same thing with shares. When we sell shares, we look at the contract date rather than the settlement date. And the settlement date might be 3 days later. So coming up to 30 June, as long as you're placing, more so with shares, as long as you're placing your sale order by 30th of June, it's okay. And if you are selling a property, then you want to, or buying a property, more so selling, if you're selling a property and you want it to be in this financial year, then you need it to have the contract date being pre-30 June. Funny story, except if you're the vendor in the situation, but I was purchasing a property, and the real estate agent turned around to me and said, can we push out the settlement until 1st of July? And I'm like, that helps me, but I'm just curious of why the reason is. And the reason was because they wanted, the reason is because they wanted to have the transaction land in the next financial year, and that's going to save them a lot of money, which is why they were willing to sell me the property at a big discount. And I was like, that's fascinating. So I signed the contract, and I signed the contract, put my name on it, and it's all irreversible. And then I said to the real estate agent, I said, I think you might want to tell your client to go back to their accountant, because I think what you just told me is incorrect. And it's just not knowing the difference between the contract date and the settlement date. But in this case, everyone here, there's 100 people here, being very careful of going, the contract date is the date that we go off for all things, whether it's property sales or share sales, it's a contract date rather than settlement date when you get the physical cash. And we're only going to pay tax on those realized gains when we've made the sale. We don't sell it on unrealized gains, which is the uplift in the market value of holding those shares. We don't pay tax on those unless Labor's proposed changes to super funds come in and you have a balance over, $3 million circular or something. If anyone been following those proposed changes for the super fund industry, if it does affect, if you've got over $3 million in super, don't put your name in the comment section, but happy for you to reach out to me and we can talk about a different strategy that you'll need to implement. But there's definitely that's the one potentially change that's going to happen in the super industry that's pretty big if it does go through. Again, it won't affect obviously it's not going to affect everyone, but if they don't change, the thing about these laws are when they put a physical dollar into it and we have inflation, if 3 million doesn't increase each year and it stays the same dollar, then it will affect everyone who's my generation. So we're hopeful that when they write it into legislation, that it's going to have some type of CPI increase that's fair and reasonable, because like we've seen with income brackets, if everyone here remembers over the last 5, 10, 20, 30, 40 years, the different income tax brackets that we've got, they haven't increased at the same rate as wages have. So we're hopeful that they're going to put something in for there. But what I wanted to do was, again, talking here about the capital gain discount. So if you are looking to exit out of any shares in the short term, if you've held them for more than 12 months, you'll be able to claim a 50% discount, even if it's owned under a trust or individual, and a 33% discount on the capital gains under a super fund. So before the next slide, which is very important, next slide. But before the next slide, I don't, like if I'm you guys and I'm thinking about my investments, I'm more likely than not to hold them for 12 months if I've already held them for 10 months. So based on the next slide, don't make any wholesale changes because of the next slide from a tax perspective, that may hurt you. But you want to be looking at, you want to be being very mindful that 12, after holding the shares, holding an investment property, holding a piece of land, holding some form of investment for more than 12 months, shares inside a non-listed business, like my accounting firm, for example, if you held it for more than 12 months, then you will be able to get a 50% discount, which is obviously important because that means your taxes are halved. Tony, yeah, this is being recorded. Assuming you typed in your email address at the start when you did the register bit, I'll send this out to everyone who's registered. My lovely team member will be able to send that out. So again, if you can't stay for the whole time, that's okay. You can always jump in and you can always jump out and watch it on recording. Oh, great question there, Peter. So can you transfer an investment property from a trust to a super fund? First thing I would suggest there is that the property has to be an investment property. And the way I define an investment property, for anyone who hasn't played this game with me before, is a property that you buy for the sole purpose of making capital gains, but that property can still cover its full expenses, including loan repayments. So normally in today's market, we're looking at a property that has that 7-8% rental yield type of property. The question is, can you transfer that into a super fund? It's got to be an arm's length transfer. So technically the super fund would be buying the property from you, and they can only buy the property from you if it's a commercial property. So if it's a residential property, the answer is no. Even if it's rented out to a random person and you're not living it or anything like that, the answer would be no. Again, inside a self-managed super fund, you cannot rent out, you cannot have a property under the super fund, and you can't have a property under the super fund and use it for personal benefit, like a holiday home, even a rental property. You can't even go there and do work on it, like maintenance work under a super fund, even though you own it. So just there are some funny rules when it comes to super funds. In that setting, I always just look at it and go, what's the best investment property for me to buy, or investment in general? What is the best investment for me to buy inside a super fund? And that's what I'm targeting. If I was to do property in a super fund, I'm going to use leverage. I'm going to borrow money from the bank, because otherwise, anyone here, put up your hand if you've ever tried to sell a bedroom in your house to buy a boat. Has anyone tried that before? Probably not. But you can sell 50 grand worth of shares to buy a boat. So when someone just sent me a message. When I look at the investment decisions that I'm doing under a self-managed super fund, I'm thinking about, well, when I need access to physical cash to withdraw out my pension payment, how am I going to derive that, or how am I going to get that? But yeah, so again, the key parts here is just remember 12 months, 50% discount under individual or trust, 12 months, 30% discount under the self-managed super fund, because it's got that lower tax rate too. So under a self-managed super fund, again, if people haven't been to my super fund webinars before, the super fund does pay tax at 15%. So if you're getting that 33% discount, you're really paying tax at 10%. If you're in pension phase, which we'll talk about later, you're paying tax at 0%. Where the individual tax return, you pay tax between 0 and 47%, less your 50% discount would obviously, if you're the top taxable income, so you're earning over $180,000 per year, you're already in that top bracket. The max tax you would pay on making a sale would be the 23.5%. Obviously subject to change if they change Medicare levy and that type of stuff, but generally speaking, 23.5% would be the max tax you would pay on an individual side of things. Okay, so again, this is more for share investors, the people that have a portfolio under, that have a share portfolio, and you're looking at doing a sell and doing a buy. So we'll just think about NAB shares. Does anyone know what the share price for NAB is today? Anyone quick? Anyone own NAB shares? No one owns NAB shares. Okay. I don't think I own NAB either. Oh, James does. Do you wanna, you can tell me someone tell me, there you go, 26 bucks. So right now we are, I think the 19th, right? We're now the 19th of June. So if we were to sell NAB shares today at this price point and we were to buy them back, do a transaction, say we held them for 12 months, 12 months, oops, and we'll do buy them back. So we crystallize a gain, crystallize a loss, whatever it may be. We do one of these. So we've actually realized the gain or loss, we've processed it, and we were to buy that back tomorrow. That is called a wash sale. So we can't buy and sell the same stock in a very short period and get a tax benefit from it. And there are reasons that you would want to do that, and we're going to talk about that shortly. But you can't do the same day. In 2 weeks' time, it's fine. 2 weeks would be a good enough time period, but definitely not the same day. But instead of NAB, my favorite Australian bank share to own personally would be probably Macquarie. So I might sell out of NAB, which is $26. I think from memory, they tanked a fair bit, and someone can correct me if they know more about NAB than what I do. I believe that they did tank because there's another one of those, what have they done? Breaching the Money Laundering Act, and you know how CBA did the same thing, got $1 billion fine. I think we're waiting for them to get a fine, and then the stock price will go back up once it's crystallized. From memory, I think that's what happened with my NAB shares. But if I was to exit out of NAB, I might jump into Macquarie instead, and I might implement the next strategy on the next page. So what we want to be, Macquarie, so 184. I think I bought it 2 weeks ago, 172 or something, I reckon. Again, I might be corrected there, but I think I just bought some recently at a lower than 184. So if you are investing in shares, what I want everyone to do right between now and the 30th of June, which is obviously why we're doing this type of webinar now rather than later, is to review share portfolio, whether it's under a super fund, whether it's under a trust, whether it's under your name, your wife's name, doesn't matter. I want you to identify your capital gains and losses. And I want you to then look at them and see if there's any opportunities to change the portfolio, or you're happy with your portfolio. And based on that, you may want to look at doing something like this. So I think this is something that I was looking at last time. I was just doing some examples for people. Alibaba, however, who's definitely not done anywhere near as good as this. This was a, in hindsight of me creating this did not work. So please don't comment on my Alibaba naming there. I should have done that. But in this case, we've got Alibaba at 48,000 profit. We've got Apple, we've got Microsoft, and I think it's what happened when I did my copied it across. But all these are positives. But what you might have is you might have Alibaba at a loss. So say we had Alibaba at a market value of $2,000, which is probably not far from the truth. I think it's around 4,000. It's 68% down. I'm a proud owner of Alibaba, and my 68% decrease in my portfolio on that one. So that one's actually trading at a $6,000 loss at the moment. So I may want to sell out of that stock, exit that stock at a loss, and offset some of that against another one of my stocks. Again, I don't know why this spreadsheet kind of got stuffed up and I didn't pick up on it, so I'm sorry about that. But I will, I'm just going to quickly stop for a second and open this up on another screen, because this is, it must have something to do with my ability to have multiple spreadsheets open at once. I'm just going to open up a better, sorry guys. Couple of people still in the waiting room. I think we capped out on the waiting room. We have too many people joining, which is, thanks everyone for joining in tonight. Sorry for the delay showing you the screen. I think it'll be more impactful if I'm able to show you the right screen. So I'm not too sure why that didn't copy across properly. Not be found, blah, 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 blah. That's nice. So just another 30 seconds. How can I not read? Oh, it's always helpful. Maybe I will not be able to do it. Keep getting a lovely error on my screen. Repair, maybe. Okay, cool. We're good to go. This is more what I wanted to show you all. It is so funny that all I did was copy it from one spreadsheet to another one and it didn't work. This is more realistic in what's happening with Alibaba. So say Alibaba is, everyone can see my screen, right? Yep. Perfect. Say Alibaba is actually down something like this. So I'm $6,500 down on my Alibaba shares. So I might want to offset that against my Apple shares, which is up $6,900. And by doing that offset, I'm going to be able to, one, not pay tax on either one of those. And two, if I'm already going to exit out of Apple because I need money for some reason, I don't want to sell Apple if it's going to cause me a capital gain. I'm going to pay tax on it without thinking about the losses. So going back to the whole point was we're going to look at here and identify if we need to exit out of any portfolio for any reason, if we want to utilize some of the losses to offset some of the gains that we've done in a prior period, if we're going to manage our portfolio in any way, we want to be looking at this and looking at what the current gains are against the current losses. These stocks are all ones I've owned, so you can see that I've made two actually dumb mistakes. If anyone want to critique me, I'm more than happy for you to ask why. I wonder a lot about why I own Square still, because I did own Afterpay and I sold out of Afterpay, and for some smart reason I bought into Square, which I never should have done. Lessons have been learnt, obviously. So I'm just going to quickly swap back over to the other presentation because I updated this one, so I don't want to go that. But does everyone understand that concept between reviewing the portfolio, offsetting your capital losses against your capital gains, and therefore, in practically we can reduce our taxes that way? And if you've got losses, you crystallize them during the year. You don't want to offset any capital gains because you love your stocks. Like, I'm not going to be honest, I'm not going to sell Apple. I'm not going to sell my Microsoft. I'm not going to sell my Visa either. I'm not going to sell those three companies. So I might just accumulate my losses. So you can carry those losses forward to future years. Absolutely. You don't need to neutralize it or get it to zero or anything like that. It's just only if you've already sold out of some stocks that have capital gains, you may look at reducing your taxes or minimizing your taxes by selling them out. So you can offset. So whether you've made capital losses through buying shares, buying property, you can offset them against any other capital gain that you've got or capital loss that you've got. So you can offset capital gains between shares. Say you bought, we extrapolate this, say we bought $100,000 worth of Alibaba and we sold it at $30,000, so we made a $70,000 loss. We would be able to offset that loss against an investment property capital gain, and vice versa. But again, you can always reach out to your accountant to make sure that you've got the correct advice there, and that's taken care of. So I'll just share my other presentation again. Get back to the right screen so everyone can see the right screen. And thankfully, it still has all my notes from before, so I don't have to rewrite them. So if there's any other questions about investing, taxes, all thing tax there, again, reach out to me. There's a couple of people that send me direct messages with a lot of detail. So that's Peter and Christine. Please, I'm not ignoring you. Those are quite extensive and detailed ones. Please reach out to contact@hatcher.com.au. Please send any of those big personal, like detailed type of stuff, so I don't have to read it out and give everyone your details. I don't want to do that, obviously. Personal information advice too. So just send it, just copy and paste that, send it to me in individual, and I'll definitely come back to you. We might as well start on that question. Can you convert a holding that you have under your individual name, I'm guessing shares, into your self-managed super fund? Short answer is no. Long answer is yes. Just like investment, if you have the right commercial investment property. But the real way of doing that transaction would be you've technically sold the shares, technically sold the property, and you physically got cash. The physical cash has been contributed into the self-managed super fund. The self-managed super fund has physically bought that asset again. So it's really a cash transaction that has occurred, rather than, it might have just happened on paper though, but it's really a cash transaction that you have to be aware of. So the important things to know, whether you've got a self-managed super fund or an industry retail fund, these are the important things to know that you need to know for the next 2 weeks. So again, whether you're in a wage earner or not, these are the two most important points. So if you're under if you're under the age of your preservation age, so for most people that would be 60. If you're under that age, you're in the accumulation phase. If you're in accumulation phase, that means you're building up your super fund. That means that you're growing that nest egg. That means it's getting bigger and bigger. And that's what the goal is. When you are in pension phase, so that means you've reached preservation age, and everyone will be slightly different depending on what year you were born. But that means that you're able to turn the switch, and you're at 0% tax rate. Sorry, everyone, I am using the Mac. I am using the Mac mouse, and the Mac mouse likes to swipe in between the pages, and I wasn't smart enough to get my Windows mouse out prior to starting this webinar. But the pension phase is at 0% tax. So let's just say you've hit 60. You've hit 60 years old, age of 60 today. Then what we would do is we'd turn on the pension as of today, and then any income that you make or is attributed to you over the next 2 weeks would be tax-free, but the whole financial year next year. So generally speaking, what we would do is we would just turn on the pension as of the 1st of July. And then the whole next financial year, you wouldn't pay any income tax on any of the investments that you own currently or into the future, as long as you're below the balance cap of 1.8 million per member. And again, that's across all your industry funds. So not just if you have one fund, if you have 5 funds, that's across all of them. You've got that balance cap. Now, the most important thing to do, if you are over the age of, say, 60, preservation age, everyone across here who's over that age bracket should be thinking about this bit here, is what is the minimum pension amount. We do have 11 days to physically transfer that money outside of the super fund to you personally. You can recontribute it, so you can go from super, really should just plug that other one in. We can go from super to individual. Should have just drawn a human, that might have been faster, and back again to super as a contribution, maybe as a concession contribution or as a non-concessional, depending on the circumstances. The most important thing is to do the pension payment before 30th of June, because that is critical in making sure that we're entitled to paying 0 tax on any profits that we make. You can see here, I've just jumped on the HO website, I've looked up how much is the amount that we have to make as a minimum pension repayment as your total fund balance. So say you have $1 million in pension phase, that means that in the 2023 financial year, so that's the one we're currently in now, that you would have to do a $20,000 withdrawal from the super fund by 30th of June to make sure that you qualify as a pension phase for the super fund. Whether it's super fund, self-managed super fund, it doesn't matter. In this case, as you get older, you can see that rate is increasing. And you can see between 2020 financial year and 2023 financial year, you've all been giving a 50% discount because the government deemed the whole COVID thing resulted in the super funds having less liquidity to be able to make the withdrawals at the full amount. Brendan's asked a question. It is a wise decision to sell shares with capital losses under underperforming ASX stocks and redeploy those funds into US stocks for a self-managed super fund who has growing net profits and keep better and better. Yeah, so if you think about, if we go back to this example, damn it. That's so annoying. But if we go back to that example and we think about the underperforming stocks and we go, you know what, is it better for me to exit out of I'll just use NAB. Is it better for me to exit out of NAB because Macquarie is going to go substantially better in the next 12, 24, 36 months? Or is it better to stay into NAB and wait for them to claw their way back up? And for me, when I'm looking at that decision, I'm going to Macquarie every day of the week. So you won't see NAB in my portfolio. You definitely won't see NAB in my portfolio. Again, someone can fact check me on this, but I vaguely remember NAB got down to like $14 after the Royal Commission, around that really low single, $14, $15, $16, something like that after the Royal Commission. I was a NAB buyer back then and I held them for many years. So I buy the banking stocks in Australia when there's some type of event happening. And once that event's over, I'll then exit out of it because I don't want to hold on to them. The same as like BHP. It's a very cyclical stock, right? So it goes up and down. And just, if you look at the share price over a 5-10 year period, you're going to see it just going up and down. It's just very cyclical. Same with the banking stocks. So because of that, I'm in it at the low point. I sell it where I think is the high point. But there's certain banks that I want to hold, especially in the US. There's certain companies I want to hold for the long term. The Apples and Microsofts, we've redeployed our capital in those underperforming stocks into those better performing stocks, that's for sure. So I get a lot of questions at this time of the year comes back to, should we invest? Should we take some of our cash that we've got and should we make additional contributions into super? It doesn't matter if it's a self-managed super fund, doesn't matter if it's a retail fund. The same question, the underlining question goes back to. So the big one is, for me, is it depends on your income. So before I told you, inside a super fund, we're going to be paying tax at 15%. And it's definitely going to happen on all of your concessional contributions. So any concessional contribution that you pay, you're paying tax inside the super fund at 15%. So we can't avoid that because outside of the super fund, we're getting a tax deduction for it. So if we're getting a tax reduction in our personal names, and say you are on, the average taxpayer in Australia is on 39% effective tax rate. So every dollar that they contribute into super, they're getting a tax deduction for 39%, and inside super, they're paying tax on 15%. So if you think about two buckets of money, if you have a share portfolio outside of super, and you're thinking about moving that share portfolio around, and you go, well, you know what? It doesn't matter if I have $1 million outside of super or $1 million inside super. It's better from my wealth creation perspective that I'm going to be paying 15% tax instead of 39% tax. So you might want to start shifting money from outside of super bucket into the super fund bucket, and over a period of years, doing concessional contributions and non-concessional contributions, you'd build that number up instead of the outside of the super balance. So my general rule is, depends on your age. If you are, again, if you're in the bracket of $45,000 worth of income and above, then you're going to be paying 32.5% in tax, or 39%, or the top marginal tax of 47%. So at that point in time, you're earning over $45,000. Making super contributions is smart from a tax deductible perspective because you're saving, you're saving 17.5% tax, you're saving 20% tax, you're saving 33%. So making that tax savings is smart, but you don't want to lock money into super if you can't access it for 50 years. unless your income is extremely high. So my general rule is you max out your concessional contributions each year. If you earn over $180,000, regardless of your age, you max them out. Then if you're closer to preservation age, so if you can see the preservation age, which is say 60, if you can see that in the next 5 or 10 years, then you look at maxing out your super contributions, your concessional ones to get the tax deduction, and your non-concessional ones. But it always comes back down to is how much physical cash do you have? So again, nobody needs to tell me how much physical cash you've got, but right now, if I open up my NAB account, I've got like a couple $1,000s of fund money. That's not enough money for me to put into super, but I would look at going, okay, I'm going to max out my super contributions. I have a portfolio of shares under a trust. I have a portfolio of shares under my super fund. And what I do is I transfer every year from my trust to my super fund, and I play around with that number. Each year it's going to be different, but I don't physically. All I'm doing is overall, I've still got my $1 million in shares. I'm just moving the bucket that they're in. So that's a strategy that I am building. And over the next 5, 10, 20, 30 years, it's going to pay huge dividends from a tax saving perspective. And this is what you need to be considering. But I'm not going to transfer too much money in 1 year, because the max I could do is say $110,000 a non-concessional contribution, but I can do 3 times that amount as a once-off bring forward rule. So I could put between now and July, I could be putting 110,000 in today. I could put 330,000 in July, and I could put 440,000 in over the next 40 days. However, by doing so, I can't, at my age bracket, 30 years until preservation age, if they don't change it, it's a pretty big risk to do that. However, if you see the HO do occasionally talk about people with huge, disgusting super balances, and that's what they did. Backwards 30 years ago, they would have put in, there was no caps on certain contributions. Over different years, it's have different rules, but that's what they would have done. They would have put in 200,000, 300,000, $500,000 when they're 20, when they're 30, when they're 40, and that compounding effect is why I think the latest one was there's like 30 or 40 people with supplementary super funds over $100 million balance, and that's how they did it, because they were obviously putting a lot into super, because super is the best taxing environment we have in Australia, excluding if they change the rules with the $3 million cap on that Labor's looking at bringing in. So you've got to be really clear on your strategy. You've got to be clear on what your age bracket is, how long until you need the money, if you do need the money, if you're going to need the money, sorry. We've got to be clear across those different areas. And we just got to be mindful that between now and 30th of June, you might go, Gary, I've got, I earn 120,000 a year. I've got a share portfolio worth, I don't know, 200,000 outside of super. I want to set up a super fund. I want to have my retail fund. I want to put in some contributions. Send me an email, and I'll give you my thoughts on what you should do. So all I'm really taking consideration would be your income, your age. Do you need the money in the next until you reach preservation age? Because once you put it in super, you can't get it out until you hit that preservation age. And what your overarching strategy is going to be. They're the 4 factors that I'm taking into consideration when I'm advising people on how much money to put into super each year. Okay. Now, business owners. So this next section, I'm just going to run through some stuff on for business owners. So if you do have a business, jump in. Happy for you to type in what industry you're in, and maybe I can tailor some of it to you. But like I said before, business owners are not escaping this audit risk. So again, we're seeing there's an audit at the moment. It's called closing the gap. And I'm like, what does closing the gap mean? Like, that's a funny audit. So I Googled it. And it is because in 2021, the Australian government expected to get some certain amount of money in taxes, and they got, I think, $10 billion less. So they're deciding that they're going to go out and audit business owners to get that extra $10 billion or whatever the number is. So it's not only individuals that are copying it from the audit perspective, it's also business owners. So compared to previous years, we're pretty concerned about this because we're seeing a worrying trend where they're, again, as I said before, they're hiring more accountants than ever before to go out and audit people. So there's a huge audit risk. for business owners. When the business owner gets an audit, it can be 2, 3, 4 times your accounting fees than what you're used to paying per year. So it can be extremely costly. And this is one reason why I dislike audits so much, because of their cost to business owners. But the most important thing to do in business, if we've taken into consideration our super contributions, if that's all taken into consideration, the most important thing to do before 30th of June would be buying any assets that you're going to be buying the next 30, 60 days and buying them before 30th of June. So for Kristen, who's in the building industry, if you're going to buy a new work ute, then my advice would be buy it before 30th of June, because then we get to fully depreciate that work ute, fully depreciate that truck, fully depreciate the set of computers, fully depreciate any type of depreciable asset 100% before 30th of June. Because if you buy it after 30th of June, say 1st of July, you go out and buy a $120,000 truck, then you go back to the old depreciation rules, which a truck would be depreciated over 8 years. You probably do 120,000 over 8 years would get you a 15 grand deduction per year. And that's a lot different from a tax perspective than getting a $120,000 deduction in year one. So you've got to be really mindful about the timing of these purchases. And if we are going to be making a purchase in the next 90 days, whether it is for the context, it's same as individuals, to be honest, the same with buying laptops and stuff. But if you are going to do a purchase in the next 90 days, do it before 30th of June, assuming the price is fair and reasonable. Here we've got some of my Hatcher drink bottles. So if I was going to do another order of 100 of these, then I think I spent $500 on them, maybe not 1,000. That seems like too much money, but I'll probably spend $500. The idea would be spend it before 30th of June, because I know I'm going to do it in the next 90 days anyway. So bring forward the spending as long as you've got the cash to do so. So you can't fault, if you don't have the cash to bring forward the spending, then it is what it is. But if you can bring forward the spending, bring forward the spending so you can claim it in this tax return rather than next tax return, and obviously the June BAS. So I've missed a couple of questions here. Peter's asked, if you make a non-concessional contribution into super and reach preservation age before your wife, can you access the funds? Absolutely. So if you make a contribution, whether it's concessional or non-concessional, into your super fund, and you're not at preservation age, when you do it, once you get to preservation age, you can access it. If your wife's not at that age, she will be able to access hers when she reaches that age. So you don't need both members to equal it. You only need only you or your fund needs to equal that. And someone asked me the other day, and I think it's very important to share this here because there's a lot of people in here, that if you were to do a self-managed super fund and you're joining your balance with your wives, with your husbands, with your children, I don't know, if your children have wives or husbands, if they're married, if you join them together and there's some type of divorce settlement type of thing, each individual person is treated in isolation. So when you do a super fund, a self-managed super fund, we can determine exactly how much money each person's balance is. So it's not like everything's just grouped together and you've now lost the ability to split up the asset. It's definitely splittable. There are, there's people here that I know that are, brothers and sisters that are in self-managed super funds, husband, wife, self-managed super funds, husband and children, self-managed super funds, and just friends. I got many clients that just go, two people, friends, put their money together, have one strategy because they get the scale of economics there and they can really scale together off doing so. So you may want to look at that. But going back to business owners, superannuation. So if you're employing people, SEG audits, super guarantee audits are like crazy at the moment because of single touch payrolls. So one of the most important things to be paying on time is super, because when you do single touch payroll, the government knows how much you should have paid in super, and then you're not processing that payment on time, bang, you get an audit. And again, the audit doesn't cost you. It's not just the time, the frustration, the unknown, the anxiety, it's the penalties, right? So in super audits, it's 100, 200% penalty. even if you're like 2 days late, if you don't follow the process, you can get 100%, 200% penalty on what the cost is. And it's devastating as an accountant when, you know, we email, talk to the business owners, we're going through an audit, we're trying to minimize it as much as we possibly can, and we get these big penalties. It sometimes is disheartening for people. So again, super audits are on the rise. We need to make sure those super payments are going through. If you do pay super to employees, again, you want to pay it before 30th of June or on 30th of June, because you want to do it in this year, so you get the tax deduction in this year. If you do it by, say, the 28th of July, the tax deduction is next year, not this year. So you want to be doing it by 30th of June. Another really important thing to remember here for all business owners is wages has, you know, the minimum wages have increased. So we need to factor that in. So if you are employing people, and if you're an employee, you all should be getting pay rises. And if you are employing people, you should be giving them pay increases. Understanding that it is a tough time for business owners, but we can't afford to run a business if we don't have an amazing team, and we need to obviously support the amazing team with wage increases. For me, if someone's in the exact same position, I just keep it simple and say that they get an inflationary increase if they haven't upskilled themselves, if they haven't jumped into the next category, then I will just do a inflationary increase. If we have been able to support that team member and guide them through, you know, navigate the system, navigate what's going on, then we will be able to, then I might be able to pay them more than that. So you might pay them, instead of paying 7%, inflation's around that 7% number now, instead of paying 7%, you may be able to look at paying, you know, 10%, 12%, some higher number if they've increased the value that they're providing as an employee now. And if you've been able to provide them with the training and the support to be able to do so compared to last year. So I'm always looking at that. I'm factoring in the inflation. So again, if $100 today is worth 7% than last year, then again, you've got to look at your expenses. Your expenses have all increased. Your income needs to increase too, and you've got to look at price increases across the board. You may not do a 7% increase on some product lines. You may look at a 10% increase on some, while you may reduce it on others. And it's always going to be subject to market, you know, the market being able to support that pay increase. If you've got decreasing sales and you increase your prices, it may result in your sales decreasing by more because of what's currently going on in the economy. So you've got to factor that into it as well, that you can't just go, my sales are down 20% because of what the market's doing. Gary said to increase my prices by 7% to include inflation. That will probably have a negative effect on the business. So again, these conversations you should be having with your accountant. You know, I'm happy to have the conversations with you about the pricing model and how that should work in your business, but it's something that you should be considering between now and July and implementing that. Instant asset threshold. So I thought this would be important because all of us have been used to just instantly writing off everything. We buy a computer for $4,000 from Apple, write it off 100%. We buy the drink bottles, we buy computer desks, we buy cars, vans, trucks, water equipment. I got a machine in my steel business, the steel business that I'm a part owner in. I got a machine there that's worth a couple $100,000. Boom, write off in year one. So we're all used to that writing off mechanism, but going back from 1st of July, instant asset write-off is increased to $20,000, but it's not above that. So you don't get it up to an unlimited amount of money anymore. So you go back to the old depreciation rules and how that works. And the final part is that I think everyone should be thinking about now, if you are a business owner, and I think this also applies for the same principle applies to investors, to be honest, but there's a time to be in the growth phase. So growth phase of a business is when you're trying to grow your business, when you're trying to grow your investments. And you think about it, even as an investor, I look at it and go, you know what, is it the right time for me to go out and buy 10 properties, or is it not the right time? And so one thing, I don't have enough money to buy 10 properties. So if I did, I probably would buy 10 properties, but I don't have the money. But is it the right time to go out and expand my investments, expand my business that I run, or is the current environment not the right time? And then the convoluted and complicated question to that, answer to that is, each residential market in each state is different. Each stock market that you invest in, Australia, US, Europe, is different. And each of them have different timing. So I would say that in the US at the start of the year, an amazing time because you could see the, mathematically you could see that the market's going to rebound. I think, NASDAQ, so NASDAQ up 25, 30%, right? S&P up 10%. Australian market's up 3%, something like that. So, if you look at the US market from an investor perspective, amazing time to be in the US market. If you look at the Australian market, it's probably more of a maintained time where you're just going to hold on to what you've got because there's no point loading it up, or you're in the exit phase. And the same principle applies in the business. Is right now, businesses across Australia, you're probably looking at, and each business may be, if you're in, there's people did answer my question before. So if you're in an agriculture business, and now I'm going to be extremely generalized, is so far out of all my farming clients, and we've got some really cool big ones, NT, Queensland, and Victoria. I don't have any notable size farms in New South Wales. But if you look at, we've had no, again, someone can correct me if I'm wrong, I don't believe we've had any floods or fires or cyclone, tornadoes, some natural disasters that have caused massive amount of crops to be destroyed or massive amount of livestock to be destroyed, which means that the prices for everything has over the last five years gone up and up and up because of fires and floods. So if you look at lamb costs, if you look at cow costs, they went up, shot up heaps. And there's some crazy numbers that you're able to sell livestock at in the last 18 months or 24 months, which is below my mind. But now that's coming back down because, there's been no natural disasters across the whole country that is in a meaningful way, which means that you got to look at that and go, it's the time to maintain that type of business and not expand. The time to expand that type of business is after a natural disaster has happened, and you might knock out the whole or half of Queensland from a livestock perspective. And you can look up when they have those bushfires or when you have the drought. You have drought in Queensland, it decimates the whole area. And that means that there's a supply and demand fluctuation. So if you're in a business that has a fluctuation of supply and demand, that's when you want to grow the business. That's when you want to push it and push up your profits. If your business and your industry is just steadily, and there's like accounting firms, to be honest, I don't think accounting firms grow by that much per year as an industry, 2 or 3% our revenue increases. If you don't want to grow your business, like I don't want to grow the accounting firm, I'm quite happy with the size and the people that we've got now. We've got an amazing team of, I think, 25 people. We've got one office in Melbourne. We have a lot of clients, and I love working with the people that I work with. And obviously there's many people on here that are clients. But do I really want to grow to be a $10 million accounting firm? People in here who know me well would say that's what you used to want, Gary, but I don't want it today. So I'm not in that growth phase, and I'm definitely not in the exit phase. But if you are in the exit phase, if you're thinking, you know what, I've had enough of my business, I'm going to exit it, then the exit phase goes for longer than 6 months. So to sell a business, it can take up to 9 months to sell a business. So if you decide, you know what, you're a business owner, you want out, you've got two options. You either close it down and get no money for it, or you sell it. I'm always for the selling the business, right? I want to get the money. So if that's the case, if you're in that exit phase mindset, you need to start the journey earlier to make sure you get the most amount of money as possible. So, just keep in mind those three phases. And the same with retirement. When we're talking about people, because there's been a lot of questions about super funds here. When people are getting near retirement, you've got to look at the portfolio that you've got, and you've got to start reducing the risk that you've got. So even in retirement as an investor, you're in the exit phase. You're in the reduced amount of risk you've got. You want to start claiming a pension. You want to start taking a pension out of your super. You can't be in 100% of your, shouldn't say can't, you can do whatever you want to do. It's your money, it's your super. That's why we do a self-managed super fund. But the risk reward situation of putting 100% of your money into like the US market with exchange rates, with a different currency, with different political issues could have a devastating effect on you in the short term if you need to take 50 grand out today, but the portfolio is down 50%, opposed to having a risk strategy where you've got 50% of your money in the US, 50% in Australia, and you minimize any of the currency problem. And you might even have 1 or 2 years worth of physical cash, your cash withdrawals in cash, so you never have to exit a market on a downturn. So the worst time, if you look at a share portfolio and you go, if your share portfolio was sitting at $500,000 and you're pretty happy with that, and you've got to take out your yearly payment because you need money to live on, and it's currently and the whole portfolio is down 20%, and it's currently trading at $400,000, and you're down here, you don't want to exit this portfolio and miss, it going back up, right? Because if you take out 20% at that 400,000 level, then you're not going to be able to get that uplift. And that's why, generally speaking, you're going to have 2 years, or you want to have, in that exit phase, you want to have 2 years worth of physical cash sitting there just in case something happens at the market. So you can weather any storms, the most recent one obviously is the COVID one. So the market crashed in 2020, March 2020 was the bottom of it. And if the Australian market, and you look over the next 18, 24 months, it rebounded. But if you had to sell out at the bottom because you needed to draw in physical money, then draw down physical money, then you wouldn't have been able to get that uplift. So that's all I have, guys and girls. I'm going to go through and answer a couple of questions. So feel free to message away any questions if you still have them. I'll stop sharing now so you can so you guys can jump on mics, can ask me anything. Obviously put up your hand maybe because there's a few people in here. I'm going to stop recording too, so it will be